The apparel industry is entering a new age of discipline. What do I mean by that? The growth at any cost is giving away to focus, to profitability, and execution. It's a trend that could get the industry back on track on a steady trajectory of not just growth, but profitable growth. Welcome to our July Inside Fashion Market Briefing. I'm Jane Singer, and rather than simply talk about what's happening, I'll be sharing insights and perspectives that help brands make smarter decisions. A lot of people ask me, what are the biggest shifts that you see? And what I see are the new rules of growth. What I mean by that is the industry has largely moved beyond the energy shock, right, that had hit us at the start of Q2. Geopolitical issues remain, but they've sort of moved to the background. They're background noise, you might say, rather than daily disruptions. The situation in the Middle East has not really changed much. However, oil prices have eased. So, in other words, market sentiment has moved on. That's a good thing because oil prices and perhaps a shortage of oil in some parts of the world were a massive concern throughout Q2. Freight rates have surged, but they're expected to retreat later in Q3 once we get past peak. We'll see if that actually happens. It's not a given because obviously carriers have a vested interest in supporting rates, and they'll do what they have to be able to limit supply, to be able to support higher rates. Whether or not that's going to work will be interesting to see. Some people say that we'll definitely be seeing lower rates, and other analysts are saying that rates will come down in the second half of the year. Again, it has to do with whether or not there's enough demand to be able to support rates, even if shipping companies reduce supply. Where there continues to be strong demand really is in intra-Asia, particularly on now fast-growing China to India routes. Intra-Asia, of course, continues to be important on account of the fact that a lot of the raw materials that are being used are coming from China, and also India has become an increasingly important buyer, particularly of goods out of China. So we see that there's still going to be rate pressure intra-Asia. But on the routes to Europe and to the US, there is an expectation that things are going to continue to retreat. So the biggest concerns right now really are rising interest rates. And for people who are importing into the US, the Section 301 tariffs, which we should know more about at the end of July. Realistically, tariffs do remain a headwind. They're a wild card, right, for planning because nobody knows what exactly the rulings will be. So therefore, nobody really knows how to plan. We don't know what kind of tariffs there'll be on. Will it be on all goods? Will it be on certain goods? The USTR has proposed a special textile, what you might call it, a textile mechanism rather than a blanket exemption. So this allows a specific volume of apparel and textiles to enter the U.S. at a reduced Section 3 tariff rate. The quota volume is tied to how much U.S. produced textile input, for example, man-made fibers and cotton, that specific country imports from the U.S. So this is not a easy to apply carve out. There's a lot of strings attached. It may be that in many cases, the juice is not worth the squeeze, if you know what I mean. The complexities of being able to fully comply with this might moot the benefit that you get from not having the full tariff load. It depends on what the actual tariff rate ends up being. So, I mean, that looks like an opportunity, but I wouldn't be getting my hopes up high on that. I would simply be keeping it on the back burner as something that may be a workaround for certain things. Now, the other thing is higher interest rates. And higher rates are forcing more discipline, as we referred to earlier, throughout the economy. At this time, we don't expect rates to surge back to post-pandemic levels. I mean, central banks have clearly hit the pause button for now on rate cuts. So I'm not expecting to see rate cuts through the end of the year. There is a good chance, according to analysts, that the US and the UK could potentially raise rates a little bit before the end of the year. I would say that at this point in time, we can expect rates to pretty much stay about where they are. We're certainly unlikely under the current circumstances to see rate cuts. So that really supports the overall trend towards greater discipline at the corporate level and a bit more mindful spending at the consumer level. Again, it's nothing on a crisis level or, earth-shattering, disruptive, but it's just something that we want to keep in mind as a point of reference. It helps to curtail that growth for the sake of growth pattern. That was a great part, was to a great extent enabled, right, by the decades of free money. And I think that's the bigger trend is that we're seeing a decoupling from that. So, with brands realizing that profitability must be a priority, and higher interest rates making it more costly to borrow, this is contributing to overall a greater move towards caution. This is most visible, of course, in smaller order sizes, as brands try to avoid overstock, even if that means potentially facing stockouts on certain items. But reducing inventory is also playing a key role in supporting another absolutely critical goal, which is selling more at full price. So I think we have to look at all these components when we try to get a big picture on what we see happening in the market, particularly heading into the second half of the year and potentially into early 2027. So people also are saying, well, asking what are winning brands doing? What are differentiating the winners in today's very competitive market? And I think this, if we look at the strongest quarterly earnings from the recent quarter, those companies have been doubling down on discipline. This is looking like it's going to become the new business model where brands move from being very expansion focused to being profit focused. It's being really, we're seeing that's continuing to drive better earnings. It's not that there's not going to be expansion. It's going to be mindful expansion. It's going to be considered expansion. It's not going to be just let's add more stores so that we can have a press release at our quarterly earnings that says we're adding more stores. It's going to be evaluating where we can add more stores that will be profitable, not just more and more line extensions. Acquisition of any brand just to be having a bigger portfolio. It will be more well thought and well considered. So I think that's a good thing. We're seeing right now, to this point, winning brands are starting to divest of a lot of brands that are not necessarily bad brands, but they're brands in their portfolios that don't really support their core DNA. So, for example, just this first half of the year, LVMH, right, sold Marc Jacobs, not because it's not a good brand, but essentially it's more aspirational luxury, whereas LVMH's real core, their strength, is in that very high-end luxury sector. So therefore, getting into more aspirational brands is in a sense a drag on the core that they need to be focusing on, particularly in a market that is becoming, like I say, a lot more competitive. At the same time, we saw Contour Brands sold off Lee. Again, another good brand, but they need to be able to double down on their Wrangler brand. Levi Strauss sold Dockers, and Alo Yoga divested its wholesale T-shirt business, Bella and Canvas, not because it wasn't good, but simply because they really wanted to be able to focus purely on high-end luxury athleisure. So having something that wasn't part of that focus wasn't an asset at a time when resources are a bit more scarce. And it's absolutely essential for brands to clearly define to the consumer who they are, what they stand for, and be able to provide a far better product rather than just simply more products. So profitable growth really has become even more important in many cases than top line growth. Capital is no longer free, so every investment has to justify itself. And more companies are realizing that investing in growing one strong brand is going to have a better payoff than amassing a portfolio that's weighed down by underperforming or loss-making brands. So this also reflects a consumer market, right, that's now prioritizes brands that have unique DNA. Consumers want substance. They want quality. They want design. They want service. We have to note the tremendous success, the ongoing success of a growing group of mid-tier brands, primarily D2C, although most of them now have physical stores as well. Brands including Cezanne, Balzac Paris, Quince, Me and M, and many, many others. The era when cheap prices and celebrity or influencer endorsements were all it took to sell is fading. Still there for teens and tweens, of course, but everyone else has essentially moved on. And so you can see that there's growth within these mid-tier brands. Now, the fact that they're not publicly listed means they're not announcing quarterly earnings. Therefore, they are not getting the media attention. It's not really possible to measure their success rates as easily as it is when somebody's public. When someone's announcing earnings, you see what the top line growth is, you see what the bottom line growth is. You're able to compare and contrast with other brands. It's hard when they're privately held, but that doesn't mean they don't exist. And the market share is there and growing. And consumers who are dissatisfied with many other brands are starting to turn to these brands in growing numbers, which is why these brands are successful. They're selling at a mid-tier price. They're focused on quality. They're growing, but they're growing strategically. And it's an interesting sector to watch. And I think it does reflect a lot of what's happening at the consumer side of the market. So, that leads us to another question right now that's very high on the question tier list, you might say, and that is, what might consumer spending look like heading into the all-important second half of the year? And I think that it will be better than a lot of predictions are. I don't think we're going to have a record-breaking year, for sure not. But it looks like consumer spending is holding strong as an aggregate of all spending. But definitely consumers are very particular right now. Um, they have a certain disposable income and they're going to spend where they see they're getting the best return, right? They want to see value, and value is not just cheap prices. Value is going to be that quality versus price. It's going to be experience. It's going to be unique product. There's a lot that goes into it. So for brands that are still thinking that they're going to just make it cheap and keep, barreling things out, that will be a bit more disappointing in terms of how well that performs at retail. So I think that that's why, getting back to our earnings reports, we're seeing brands that are focused and looking to really cut SKUs, cut extra lines, cut some of the brands in their portfolios and really make one brand that shines. Those guys are smart. I think that they are in line with where consumer demand is going. That said, unquestionably, this is not a boom period. So it's not the recession era that economists have been promising us or threatening for about 2 years now. We've managed to avoid that. But no doubt, people are being a little more cautious with their spending. We've seen the credit card companies and also buy now, pay later, seeing more consumer activity on that side. So we're not in a desperate situation. But for example, J.D. Power has said that 37% of U.S. consumers reported using BNPL, which is about 5% up from a year ago. And about half of European consumers now use BNPL services for about 8 to 9% of all of the European e-commerce, according to Oliver Wyman. So again, we're seeing a growth in that. We're seeing a growth in the use of buy now, pay later, use of credit cards. But are people maxed out on these credit vehicles? At the moment, no. But the fact that more of it has shifted to that means that there's a little bit less bandwidth to be able to lean into credit during the holiday season, unless they clear up those balances before the season. So yes, H2 is going to feel some constraints at the consumer level. Certainly, brands are going to have to fight harder for those consumer dollars because they're going to be competing against not only all the other brands in the same category, but everything else that consumers are favoring, which nowadays is very heavily into experiences. Concerts and sport events and travel and dining out all are grabbing a much bigger share, as we know, of consumer spending. Now, people are also saying, what is happening around AI? There is so much talk around AI, and a lot of companies have said to me, what do you see happening within AI or tech in general? And I think that, AI has had so much hype that the hype is bigger than the actual use. Now, I'm not talking about the $20 a month ChatGPT or Claude or Gemini subscriptions that people have. I'm talking about enterprise use. And I think that right now, certainly within the apparel industry, companies are looking really at this, but through a very cautious eye. And they're smart to do that. Realistically, there's a lot of gray areas. There's a lot of things that have not been addressed yet. There's a lot of things we don't know yet, particularly around cost, but also around risk. I mean, it's interesting to note that some of the bigger players in tech, for example, Microsoft and Uber, have cut back on their spending on AI recently. And it's because they found that the costs were getting out of control. And I think that's really an important thing for us to note in the apparel industry. We can learn from other people's experiences. So I think that AI overall is still a lot of untested areas. Where I do see brands using it successfully is in more, you may say, controlled use, which is iterating on design. I see a lot more of it on the design side of it, where that's working successfully, where brands are able to take a design and easily create multiple iterations of it through AI faster than they could do with other technologies. But I don't see that any brands are rushing in. What I do see is there's a tremendous amount of chatter around everything that Shein has accomplished by using AI to analyze trends and what's selling and consumer demand and be able to very quickly produce and ship the trendiest items as fast as possible. And it's a wonderful model. It's an interesting model, but it's not the model for everybody. I think that we can't say that this now defines the market or this is now the way we should be doing things. It's just a way that one company has done things and it works really well for them, and it may or may not be applicable to other companies. So smart companies are really taking a look before they leap approach rather than, chasing the next hype cycle. We see more interest in being able to focus on getting better data, cleaner data, processes, governance, a wide range of less, let's say, glamorous solutions, but things that are helping companies to be able to position themselves to be more agile, to have the kind of transparency that now is being demanded, particularly from regulations around sustainability. So these are things companies are leaning into. Risk reduction, flexibility. So yes, AI will play a role at some point, but what role? We've really yet to be able to identify a clear, not only use case, but also what that will cost. So people have said to me, well, what do you feel, Jane, looking ahead? When you look at the second half of the year, what are you expecting? And I would say I remain cautiously optimistic about back to school and holiday. I think the market is healthier than many headlines suggest. But again, success will depend on disciplined execution. The companies that outperform won't necessarily be the biggest. They'll be the ones that focus resources, invest wisely, and execute consistently. Again, discipline, being able to stay with one thing as opposed to, basically chasing every shiny object that comes out there. When this looks interesting, that looks interesting. Oh, I heard these guys are making money doing that. Let's try that. Running in a million different directions, which has basically been the way things have gone previously. So I think that as brands are continuing to understand that we need to get back to focus, I think that's going to help a lot. That's going to put some brands way ahead. And I think more brands are going to look at that and follow. So we go into a lot of these topics in more depth and inside fashion. We also identify growth markets, which I think is really important. So we're looking at not only geographical markets, but a lot of its categories where we see opportunities for huge growth, not just growth in volume, but also growth in profitability. For example, we recently just talked about the medical wear market, which I personally think is going to be massive, combining both the functional and performance side of things with more of a style component. So for people who, like us, who already know how to make garments, because that's our industry, a lot of opportunities there. I really see it as being the next sort of athletic wear or active wear category. Because it pulls in those components. There's really a lot of growth there, and the addressable market is absolutely huge. So that's something that you might want to take a look at. We also look at other similar categories: wellness wear, functional basics, and not just performance. We're looking at, like I mentioned earlier, the mid-tier brands that are rising. So we think there is opportunities in the market, but it's just a matter of being able to understand what they are and being able to rethink how we approach business now that the market has changed quite a lot. Well, that's all for now. Thank you for joining me here. If you have any questions that you'd like me to address, head on over to our website at insidefashionlive.net. You'll see a link there for Contact Us. Use that to be able to reach out to me. I will definitely read everything that comes in, and I would love to hear from you. Thank you for joining me, and I will see you in the next briefing.